What's up, everybody? It's Professor Reiko here, starting a new chapter today. This one is on pension plan or accounting for pensions. This will be chapter 20 in your KESO book, I believe. So pension plans are just think of them as a retirement plan. So it's the company providing benefits to employees once they retire. All right, they are their own separate legal entity, so they do have their separate audit. So some of you guys are in the audit side of things, maybe like in the summertime when things might be a little bit slower, you might do some pension plan audits. And we're going to focus on this chapter on obviously the employer side of things, not the employee. Although when we talk about retirement planning and stuff from the individual personal finance point of view, it's easy to think about your own individual investing, but we're dealing with the accounting for it on the company side. All right, so there's two main plans. We'll have defined contribution and on the next page, defined benefit. All right, we'll spend most of the chapter on defined benefit, mainly because the accounting for defined contribution is really easy. All right, so defined contribution plans are your most popular ones. This is your 401k, or 403b if you work for a not-for-profit. So all these numbers mean that's just the portion of the tax code where they come from. The 401k, 403b, they're basically the same thing, except 401k is for profit companies that are for-profit, like all your corporations and whatnot, and then 403b are not-for-profits like universities, for example. All right, so remember, it's called defined contribution. So if we look here on employer contribution, contribution is defined. Over here, employee contribution is defined. Okay, notice it says defined but varies. All right, so on the employer side, this is what we refer to as the match. All right, a lot of times within retirement plans, you hear the company provides a match. That's what the employer is going to put into it. Now, they're not legally obligated to match anything, right? So they don't have to do anything, but most companies do. All right. The employee contribution is how much you, the employee, decides to put in. All right. So, and this amount varies. You don't have to put anything in. I highly recommend against that, but you don't have to put anything in your plan. And usually you can max out at 15% of your salary. So anywhere between 0 and 15% is usually what you have the option to do. I always encourage my students, kind of the personal finance thing, to do the minimum it takes to get the full company match. Meaning, let's say your company matches up to 5%. That means if you put 5% in, they put 5%. But if you only put 4% in, they would only put 4%. They're going to match up to 5. All right. So I encourage you to at least put 5% in that situation, because let's think about it. You put 5% in, your company puts 5% in, that's free money. All right. So that's always, and it will help your retirement plan grow over time. Okay. Obviously, you want to get out of debt as quick as possible once you leave school and things like that. We could spend a whole semester talking about personal finance as well. All right. The reason most of you will do this, and I recommend you to do this, you have the choice, is because your money goes to a trustee. All right. Any of the big brokerage houses can be trustees. All right. And there the money is invested. What I like about this is the employee, meaning you and the personal finance side of things, has control. So I could literally pull up my university's 403b plan right now, and I could move money around, change how my next contribution is going to be allocated, whatever I want to do. I'm in control of that, right? So, that's the thing I like about that. You get to pick how money is invested. All right, but because you're in charge, the employee takes all the risk. All right. Now, if I just put my money that goes into my retirement plan into some sort of like money market account option within the things I have available to me, I'm not going to, I'm going to make 1-2%, and that's about it. Right. So I'm actually not really making any money when you kind of factor inflation into that. All right. So you are in charge. All right. So the contribution is defined. How much we get at retirement is not. Okay. So this is going to depend on time, meaning how long we have it invested. I mean, if you look at time value of money, the longer you have things invested, the more it grows. The amount that's invested, right? If I put 0 or 2, let's say I put 2% in as opposed to putting 10% in, that's obviously going to affect how much I have at retirement. And then how invested, meaning is it in risky or, like in equities and things like that have potential to grow a lot of time, or is it like the example I said where it's all in a money market? right? So all this is going to vary, and it's going to kind of help determine how much you'll have at the end. All right, but once again, you're in control of this. The money goes. Your employer will take the money out of your paycheck. They will match whatever portion they are going to match, and they will send it to the trustee. When it gets to the trustee, you are now in control. Right? So it's very simple accounting. So if we look down here at the bottom, the pension expense is the employer's annual cost. So actually, I'm going to draw a line here. The match is this amount right here. So it's the amount that they are obligated to contribute. Now, they might have annual fees and things that they have to pay to the trustee and stuff like that that they're also accounting for. But for the most part, that is their one journal entry. Okay, so very simple. All right, there's a number of things you have to disclose. You can see here. But the accounting for it is simple. And the main thing is, notice here, there is no liability. There's no obligation. The only obligation is for the company to match, and technically they can stop that if they want to, by getting a new plan approved within their company. They don't have to do, they're not legally obligated to match. Some companies do not, and then some companies are very generous, right? So it's just another perk to look at when you go to work somewhere. All right, so what we're going to spend the chapter on is defined benefit plans. All right, so when you see defined benefit, typically what I think of when you hear them, on the news and stuff talking about pension plans. All right, this is a defined benefit, meaning the amount that we get at retirement is defined by some sort of formula. We'll talk about that in a second. All right, now look, the employee contribution is typically still defined. Usually employees still have to contribute some percent of their salary to that. However, the employee contribution is not defined. All right, and basically what we're going to do is we'll look down here. We talks about actuary. Actuaries are going to help determine how much we need to fund into these plans. All right, so there'll be a number that the employers are going to contribute to the plan. Okay. However, the employer is taking the risk, assuming the risk. Right? They have to make sure that there's enough money in the plan to pay all their retired employees. All right. So the money still goes to a trustee. The main difference here is the employer has control, meaning you, the individual, has no control over how this money is invested. All right. So that's something to consider as well. All right. So newer companies won't even offer a pension plan. They'll all be 401k plans just because there's no, like we said on the previous page, no liability or anything like that they have to deal with. All right, so the amount, so this is the defined benefit, meaning what we get on the back end is defined. Okay, and it's usually defined by some sort of formula. So here's kind of like a rough formula. Every company is going to be a little bit different, but it's going to be some sort of calculation that takes like number of years worked. All right, so the longer you work someplace, the higher your benefits will be. Times some sort of average salary. It may be your average salary of your last 5 years, or your last 3 years, or the average salary of your highest 3 years, or just some sort of salary number. And then they're going to multiply that times some sort of factor to come out with the amount that you're going to get each period. Right? And so that is determined, and then you'll get the same amount every month in retirement, or however often you elect to receive it. All right, a big factor in these type of plans are actuaries. All right, because there's a lot of estimates. Let's think about this. If we are think about this formula right here. If we're paying that I'm saying the company, if the company has to pay that to their retired employees until they die, well, we need to be able to estimate number of years they're going to work, what their highest salary is. We need to estimate how long they're going to live. All those types of things have to be estimated. So we use actuaries to do that to help us come up with how much we should contribute to the plan. Okay, so a lot of pension plans, you hear them in the news all the time, are struggling. Well, some are, I should say. And a lot depends on how the market's doing. But the main thing is if you're paying this to somebody till they die, well, a lot of these pension plans were started when people would, work to their 65 and then didn't live past 75, whereas now people are living to be 90, 100 years old, so they have to pay these benefits out for a number of years in many cases, and so it's kind of hurt some of these retirement plans as far as managing them. right? So these are your two basic types of plans. What we're going to do to go into next is the accounting on really the defined benefit side of things. How do we account for the obligation that the company has? What is the value of our pension asset and liability? And what is our pension expense? All those type things we're going to start getting into next, and then just gradually build on an example that we're going to do over the next several videos. All right, so make sure you tune in. Basically, it's just kind of one continuous problem. All these videos are that we'll start with the second one, and we just add stuff each year to it, so they all kind of go together. All right, so we'll see you next time, and we jump into the accounting for these type of pension plans. See you next time.